Hello traders, this is Christian from Tribeca Trade Group with your weekend video. So I like to always do a quick recap of last week, just monster performance. Look at the small caps last week, up 10.1%, S&P was up 4%, but really a big snapback. If you remember the prior week when we shot this video last week, we talked about small caps underperforming, and that was risk off mode. Last week, risk was on. Small caps were up 10.1%. Very interesting performance there. And the other area that I want to draw you into is what happened in terms of inflows last week. Just massive catch up, getting out of cash and going into equity ETFs. $31 billion being added into equity ETFs. And this is mostly US or domestic ETFs. And I'm going to drill into where the money was being moved around for that $31 billion. But, one of the reasons why I look at ETF flows is because this is evidence of where the market reaction, we talked about in the trading room last week, massive volumes that we saw, in names like XLF, XLI, XLV, SPY themselves as well. But, obviously it looked like buying, right? But, how there's very few certainties in investing, and one of them is I could always see, a day afterwards what the inflows were and what the outflows were. So, this is evidence, and it is what it is. It's $31 billion that were allocated and put back into equity ETFs. So just monster inflows, big risk appetite, and this kind of makes sense. Makes perfect sense to me. And prior to the election, we really didn't have much. There was no risk appetite at all. There was no buying whatsoever. No momentum. We had 9 straight days of a down market, and no one wanted to buy. There was just people were waiting, and there was just a ton of uncertainty in the market. Once that uncertainty abates, people rush back in. So that's what we saw last week. Just to take a look at that. I did. This is what I provide our subscribers every week. Largest sector inflows. They went into financials. They went into healthcare. Financials close to $5 billion. Healthcare close to $3.2 billion. Industrials $2.3 billion. Some of the other sectors, tech really wasn't where the action was out last week. It was in some of these other very rate sensitive election type trades going on. So tech did see inflows of $750 million, but really dwarfed by the size of the financials, healthcare, and industrials inflows. Materials and energy also saw inflows. And then taking a look at the outflows, it wasn't just a massive running into every area of the market. REITs, consumer staples, and utilities also all saw sizable outflows. So something really to watch there. Take a look at the move in bonds last week. Just also a big downside move. TLT was down 7.4% for the week. Okay, so that's kind of a recap for the last week. That's where the money was put to work in the market. What I want to concentrate on next is things to watch for the upcoming week. And one of the things that I take a look at from time to time is implied correlations. We saw every day we look at market breadth. We look at obviously what the S&P is doing, and the S&P, if you go back up here again, you could see that, still a very nice week, up 3.8%. But you look at some of the other areas in the market, which I'll bring you down here just for performance wise. Regional banks up 15%, biotech up 14%, steel names up 12%. So, the S&P had a nice move, but if you look at these implied correlations, it starts to make a little bit more sense. And what's happening here is that the way that the stocks are moving inside the S&P is they are not moving in tandem or in unison. They're actually separating away from themselves. When you have implied correlations at a 2-year low, some sectors are doing very well, some sectors are doing poorly. And I did see people on Twitter last week kind of scratching their heads a little bit saying, hey, why is market breadth not so strong here? Well, it's because you saw utilities down 2% one day. You saw consumer staples down 2%. These are declining, and you have other names that are advancing big time. So that's why you're not going to see that strong market breadth, because not every stock is participating to the upside. So what what's optimal for this type of market for me, and how I like to trade when I see implied correlations down this long, down this much, is a long short type strategy, meaning I can be long some names and I can be short the underperformers, and I can make money on both sides. Of course, it's not as easy as that. You have to pick the right areas to be in, but I'm going to walk through a couple of those areas that I think are going to be in. Just a couple of technicals to watch here in the S&P 500. Looking at the daily chart. So again, I think that the S&P looks fine, and I think it can continue to move higher, but it may not be as robust because you have those implied correlations, stocks not moving together inside the S&P 500. And I'm going to show you what I mean in terms of sectors. But first thing to watch, here's your support level. And you could use SPY. I'm using SPY in this situation. Sometimes I do this analysis with S&P futures, but I'm going to do it with SPY this week. So 219.60. We also have this upward trend line that I've got drawn in here. And, we want to get back above this trend line. Also, I think what's on the horizon too is 219.60. That is the yearly high. So those are the three levels. First, the support is 215.22. As long as we're above that, I think we're fine. If we're not, we have to reassess. But as long as we're above that level, fine. And these are two of the upside areas to watch. Next, I mentioned sectors. Last week, horrible, right? We had 6 sectors underneath the 200-day moving average. You didn't have anything above the 50-day moving average. Quite a turnaround from last week. You now have 4 sectors back above the 50-day moving average and looking strong. That's financials, energy, industrials, materials. You have a couple areas that are neutral to me: tech and consumer discretionary, and then you've got the weak names. Notice the weak names, all defensive, higher yielding areas of the market. So really an interesting change going on in the marketplace. Talked about already the inflows and outflows. Other areas that were notable was emerging markets. Emerging markets had $1.8 billion in outflows. If you remember, they had 17 straight weeks of inflows, which was stopped not the last week, but the week before. Which was snapped 2 weeks ago, but for a group they were down 3.8%. And other areas to watch in international markets: Japan, Italy, and China. Japan and Italy saw inflows, China saw outflows. So it'll be interesting to watch these emerging markets, which were so in favor for the first 3 quarters of the year, call it, and now seeing a bit of outflows happen in that area. We covered the inflows and outflows. I want to jump into what to watch for this week. Well, financials, if you look at the XLF chart, which I'm just going to jump to that, and I do like this group. It saw just a massive move last week. They're overbought, so I think they're due for a little bit of a pullback here. The XLF ETF is an 83. Remember, anything above 70 using an RSI indicator is overbought. So XLF at an 83 just tells me that this group is a bit overbought. So I would like to wait a little bit for a pullback to maybe get back involved. I am long a little bit of Citigroup. Citigroup had an inside day on Friday, so maybe there's a little bit more continuation here to the upside with Citigroup. So that's one name that I'm in. But then, if you look over at European financials, which we saw a decent, very strong call buying in Credit Suisse, Deutsche Bank last week. EUFN is the European financials ETF. This is an area that could really play catch up a bit here. I've got a couple moving averages on my chart. You can see the light blue is the 50 period moving average or 50-day moving average crossing above the 200-day moving average. So the price action is now above both of these. That's a strong sign. And, I'm looking at this group to really play. I am long a bit of Credit Suisse. I will look to possibly establish a position in this EUFN ETF next week, European financials. Again, if yields are going to stay and do what they're doing, positive for banks and financials. Next, so that's we highlighted this in the newsletter. Credit Suisse, Deutsche Bank. I think the Deutsche Bank chart looks really interesting as well. Similar pattern there. Now moving above the 200-day moving average, which we haven't seen in a long time. Next, I like materials. If you watched my video last week, or if you're a subscriber to Tribeca Trade Group, we talked about copper last week, and in last week's newsletter we talked about copper, we talked about FCX, we talked about XME, we talked about the base metals, DBB. So what's next here? All those trades worked out wonderfully, and so what I'm looking at now is the one thing that you have to be a little bit wary of in the XME metals and mining ETF is you have gold miners, which really sold off hard last week. So two different areas that are in that XME ETF. You have a little bit of materials names, you have steel names, and you have gold miners. So I really don't want to be a part of the gold miners. They fell below the 200-day moving average last week. What I'm looking at, and an ETF that I prefer right now is XLB. That's the materials ETF. And if you look at the names that are in here, I think these names have a little bit more upside, or, a possible breakout on the horizon in this particular group. So what I'm watching here is if I go to the weekly chart for this one, and I'm watching 48.23, I think a move above there. We also have this area of consolidation. I think we can possibly get above there if we can get above 48.23 first. You could see for the weekly bar, we actually got above there in the middle of the week, and we pulled back a little bit. So that's the area that I'm watching in XLB. And then finally, on the long side, ITA, you go back up to my inflows and outflows spreadsheet. And if you go to the industrials, you could see, look at all these aerospace and defense. This is not something that we've seen in 2016. ITA, XAR, PPA, these are the aerospace and defense ETFs, really see a lot of inflows. And keep in mind, these are much smaller funds than, let's say, XLI. You can see that the inflows change the outstanding shares or the fund size by 55%, 17%, 7.5%. So big moves for these smaller funds. So this thing is definitely breaking out. This group is definitely breaking out. You could see this monster on the weekly chart, this monster move up here, and it's breaking out. So what I would watch for next week, we look at what names are in the aerospace and defense ETFs, and it's Boeing, it's UTX, it's LMT. Some of these names really had good earnings as well. So I'm looking for more aggressive call buying in that group. So that's an area that I have an eye on for next week. I think these things can continue to rage, but I want to see those sharp aggressive call buyers in that group. And then, so those are three areas that I'm watching for a continuation or upside move, bullish moves. Bearish, I want to stick with an area, and I'm going to repeat myself a little bit. I sent out a video earlier in the week about a short idea in the REITs ETF. Why do I think that that's a good trade to the downside? Well, if you look at Treasury bond yields right now, the 10-year is yielding 2.5%. The 30-year is yielding almost 3%. So as we've seen a lot of outflows that I detailed earlier in the video, I think REITs could have a lot more to go to the downside. And I'll show you what the investment has been in the VNQ ETF. This is a very, very large ETF in terms of assets. It's I think it's $30 billion that are in this particular ETF. And the white line on this particular chart is the outstanding shares. You could see this climb up, 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 and up over the last 5 years as yields have gone down. The green chart is VNQ. So VNQ has come down from the highs, but I think we're going to see a breakdown. Now, you never know when funds are going to allocate away from this group, but you could see that this massive inflows this year, I would think that if yields stay where they are, there's going to be money taking out. So I'm speculating here, but I think a short trade in VNQ or IYR, which is what we did on Friday in the trading room, which I'm not going to go through that because you need to be a subscriber of Tribeca Trade Group to get the details of that trade. But you can go and you can sign up tribecatradegroup.com, and you can get involved in our weekly plan or our newsletter program, and you can see these types of trades. But that's what I'm looking for in terms of short. As I mentioned in the beginning video, long short I think works well in this environment, and that's a particular short idea. We do have a bunch of other stocks to watch. Like I said, you do have to be a subscriber of TTG to get those, but go ahead and sign up, and you'll get those, and you'll see those ideas. So thank you very much for watching the video. Have a lovely Sunday, and good luck trading next week. Thank you.